Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
So you're running a business, right? You know that moment you finally buy that big ticket item you need, a powerful new computer, a company car, maybe some actual office furniture. It feels great. But then tax time rolls around. And the big question is, how do you actually write this stuff off? You can't just deduct the whole cost in one shot. Well, today we're going to untangle all of that. We're diving deep into the Canadian rules for writing off business assets. And I promise, by the end of this, you'll have a clear roadmap. You know, I love this quote from Johnny Carson because it just nails what it means to be an entrepreneur. Having the talent, having a great idea, that's just the start. The real question is, are you ready for the business side of things? Because being ready for the financial realities, especially taxes, is what really sets you up for success. Okay, so here's our game plan for today. We're going to start with a story about Jared's big tax problem. Then we'll introduce the solution, which is something called CCA. We'll decode all the rules, run through a real-world buy versus lease case study, talk about what happens when you get rid of an asset, and finally, we'll build your very own tax strategy blueprint. First up, let's talk about Jared. And believe me, his problem is a classic. It's a challenge that pretty much every new entrepreneur bumps into. So let me introduce you to Jared. He's a total computer whiz. He started out doing some IT subcontracting on the side while he was working as a waiter, just to make some extra cash. But he was so good at it that referrals just started flooding in. Before he knew it, bam, he had a full-time, thriving business. He was making great money, but then his first tax year came to a close, and he hit a major roadblock. And here it is. This was his problem. To get his business off the ground, he'd bought a brand new computer, some used desks and chairs, and to top it off, his parents gifted him a car to use for client meetings. He just figured, great, I'll just write off the full cost of everything. But then his accountant starts talking about this thing called CCA, and Jared's eyes just glazed over. He had no clue what to do. How do you possibly handle new things, used things, and even gifted things on a tax return? It's that exact confusion that we are going to clear up right now. Now, the good news is there is absolutely a solution to Jared's problem, and it's one of the most fundamental concepts you need to know in Canadian business tax. And that solution is called capital cost allowance, or CCA for short. Okay, think of it like this. The Canada Revenue Agency gets it. They know your business assets, that car, that computer. They lose value over time. They get old, they wear out. CCA is simply the system the government created to let you deduct a piece of that asset's cost each year to account for that wear and tear. But here's the absolute key. It is not a one-time 100% write-off. It's a deduction that you spread out over several years. This is a really important distinction you got to get your head around. Expensing something versus capitalizing it. So let's say a storm blows a few shingles off your office roof. You hire someone to replace just those shingles. That's a repair, a maintenance cost. Boom, you can deduct 100% of that cost right away. But what if you decide to replace the entire roof with brand new, better quality materials that will last for 30 years? That's not a repair. That's a major improvement. That's a capital expenditure, and you have to capitalize it and write it off over many years using CCA. Now, this is a part you really need to pay attention to because it's a huge strategic advantage. CCA is what's called a permissive deduction. That means you don't have to claim it. Every year, you can choose to claim any amount you want, from zero right up to the maximum allowed. So let's say your income is kind of low this year. You could claim zero CCA and save that deduction for a future year when you're in a higher tax bracket, and it'll save you way more money. But, and this is a big but, be careful. If you make a mistake on your claim, you only have 90 days after you get your notice of assessment to fix it. That is a tiny window, so you want to get it right the first time. All right, so we know what CCA is in theory, but now it's time to roll up our sleeves and get into the nitty-gritty of how it actually works. Let's decode these rules.
So the way the CRA keeps everything organized is by putting assets into different classes, and each class has its own annual deduction rate. For example, your office furniture and fixtures, they go into Class 8, which gets a 20% write-off each year. Your computer hardware and software, thankfully, are in Class 50, which has a super fast 55% rate. And check out Class 12 for small tools under $500. You get to write off 100% of the cost in the very first year. That's a fantastic exception to remember for all those little purchases.
Okay, now this is where things get really interesting. Let's talk about the first year you own an asset. For the longest time, there was something called the half-year rule, which meant you could only claim half the normal deduction in year one. But then, in late 2018, the government introduced a total game changer called the Accelerated Investment Incentive Property, or AIIP. As you can see, for a few years, it let you claim 150% of the normal rate in the first year. A massive boost. That incentive is phasing out now, but even the phase out is more generous than the old rule. This is a huge deal because it lets you get your tax deductions way faster.
All right, if you're thinking about buying a car or a truck for your business, you've got to know this number. There's a cap. For most passenger vehicles, which go into Class 10.1, the maximum cost you can use for your CCA calculation is $30,000 plus taxes. So even if you go out and buy a $60,000 luxury SUV, the CRA only lets you base your deductions on a value of $30,000. It's a really important limit to remember. And speaking of big incentives, whoa, get a load of this. To push businesses toward going green, there are some incredible rules for zero-emission vehicles. First, that $30,000 cap gets boosted to $55,000. And even better, if you bought an eligible vehicle before 2024, you could write off 100%, the entire cost in the very first year. Just compare that to a regular gas car, which even during the best AIP period only got a 45% write-off. That's an absolutely massive tax advantage. We've thrown a lot of theory at you, but how does all of this actually play out when you have to make a real business decision? Well, this case study is going to put it all together. This has got to be one of the most common questions business owners grapple with. And when you first look at it, leasing often seems like the cheaper option. But the real answer isn't about the monthly payment staring you in the face. It's all about the total after-tax cost over the long haul. And this, right here, is where understanding CCA becomes your superpower. Okay, let's look at the raw numbers for a typical business vehicle. If you buy, your monthly loan payment is $867. If you lease, it's only $619. So from a cash flow perspective, leasing seems like a no-brainer, right? You're paying out less cash each month. But wait, that's only half the story. Now, let's fast forward 3 years and see what the tax man thinks. When you buy, your total deductions add up to almost $35,000. With the lease, it's under $31,000. So if we assume a 35% tax rate, buying the car actually generated over $1,400 more in real, cold, hard tax savings. That higher monthly payment was more than wiped out by the bigger tax deductions. So you're probably asking yourself, how is that even possible? Why is buying so much better from a tax standpoint? Well, this slide shows you the secret sauce. It is the raw power of those accelerated CCA rules. Look at year 1. You get to claim a massive deduction of over $15,000. That huge upfront claim is what creates all the tax savings. When you lease, you just deduct your monthly payments, nice and steady. But buying, thanks to CCA, lets you pack a huge punch in that first year. Okay, so an asset's journey with your business doesn't just end when you stop using it. There's one last piece of the puzzle you need to handle on your tax return, accounting for what happens when you get rid of it. When you sell or dispose of the very last asset in a particular CCA class, one of two things is going to happen. If you sell it for more than its leftover tax value, what's called the undepreciated capital cost, or UCC, you have something called recapture. Basically, it means you claimed a little too much depreciation over the years and you have to add that extra amount back to your income. But if you sell it for less than the UCC, you get what's called a terminal loss, and you get to take that amount as a final deduction. It's just the tax system's way of balancing the books at the very end. Whew, we have covered a ton of ground. So now let's bring this all home. Let's turn all these rules and regulations into a powerful, actionable strategy that you can actually use. This is your blueprint. And this all comes back to the most important thing we've talked about today. CCA isn't just a boring rule you have to follow. It is a powerful financial planning tool that you control. Remember we called it a permissive deduction? That's your control panel. When you have a fantastic, high-income year, you claim the maximum CCA to slash that tax bill. But if you have a slow year, you can choose to claim nothing and save that big deduction for a future year when it will have a much bigger impact. And think about the ripple effects. A smart CCA claim lowers your net business income. That can actually lower the amount you have to contribute to CPP. It can also help you maximize your RSP contribution room. It's all about timing your big purchases and your sales to match your income. So the real question isn't just what can you write off, it's when is the smartest time to do it to shape your own financial future. Nailing that, that's the difference between just doing your books and playing chess with your taxes.